Ever wondered how the rich keep getting richer while the rest of us struggle to make ends meet? It's a question that's bothered many of us, hasn't it? You see, there's a perceived disparity between the wealthy and the average person. The rich seem to have a knack for accumulating wealth, while the rest of us grapple with bills and taxes. How do they do it, you ask? Well, one key factor is their mastery of tax avoidance strategies. They've mastered the art of making the tax system work for them, not against them. They use loopholes, legal provisions, and even geographical locations to minimize their tax liabilities. This doesn't mean they're breaking the law, far from it. These strategies are legal, but they're often complex and not widely known or understood. But don't worry, we're about to change that. Stay tuned as we uncover the 10 ways the rich avoid paying taxes. Starting off at number 10, we have offshore accounts. Now, what are these exactly? Well, they're bank accounts located outside the country of residence of the account holder. The wealthy often use these accounts as a tool to stash their money, effectively hiding it away from their home country's tax authorities. This method has been controversial, to say the least. You've probably heard about some infamous cases of offshore tax evasion in the news, where billions of dollars were hidden from prying taxmen. But let's not name names. The key point here is that this strategy has been a well-used playbook in the game of tax avoidance for the wealthy. However, it's worth noting that the effectiveness of offshore accounts as a tax avoidance strategy is dwindling. International regulatory bodies are cracking down on these practices, making it harder for the wealthy to hide their assets. While this strategy is gradually becoming less effective due to international crackdowns, it's still in play. Coming in at number 9, we have trusts. Now, trusts aren't just for leaving your wealth to your heirs. They can also be a strategic way to minimize tax liability. Let's break it down. A trust essentially splits the ownership of assets, with a trustee managing the assets for the benefit of the beneficiaries. But here's the kicker. The assets in a trust aren't counted as part of the grantor's taxable estate. This means they're not subject to estate taxes upon the grantor's death. Additionally, trusts can distribute income to beneficiaries who may be in a lower tax bracket, reducing overall income tax. Certain types of trusts, such as irrevocable trusts, even allow you to remove assets from your estate entirely, further reducing potential estate taxes. It's a bit like a magic trick, making assets disappear from the taxman's view. Trusts, when used correctly, can be a powerful tool for tax reduction. At number 8, we have real estate loopholes. One of the most effective financial strategies the rich employ is investing in real estate. But it's not just about buying and selling properties. It's about knowing how to navigate the tax laws around it. Did you know that property owners can significantly reduce their tax bills through depreciation? This is a non-cash expense that allows them to deduct the cost of buildings over a period of time. It's like a magic trick, making a portion of their income disappear from the taxman's sight. Moreover, there's the 1031 exchange. This provision allows investors to sell a property and reinvest the proceeds in a new one, deferring capital gains tax. It's like passing the tax buck onto the next property. And let's not forget about the mortgage interest deduction, another gem in the real estate tax law that can lead to substantial savings. The real estate market is a goldmine for tax-saving opportunities if you know where to look. Number 7 on our list is philanthropy. Now, don't get confused, we're not saying rich folks are saints, but here's the trick. Generously donating to charitable causes can result in substantial tax deductions. By giving away part of their wealth, the affluent can significantly reduce their taxable income. This isn't just about big-heartedness, it's a well-calculated financial strategy. And it doesn't hurt that it also polishes their public image. Remember, philanthropy isn't just about generosity, it's also a strategic move. Coming in at number 6, we have shell companies. Now, these are not businesses related to seashells or the petroleum giant. Rather, they're entities that exist on paper, but have no real employees or operations. Yet, they are completely legal. But why do they exist, you might ask? Well, they're often used as a smokescreen to obscure the real company's profits and assets. Let's say a wealthy individual owns a profitable business. They can set up a shell company in a tax-friendly jurisdiction and make it appear as if the shell company is making the profits, not the real business. This way, the real business's tax liability is reduced or even eliminated. The money saved can then be funneled back into the business or the owner's pockets. Shell companies can be a complex and dangerous game, but they're still used by the wealthy. It's a strategy that requires careful planning, legal advice, and a certain level of audacity. Halfway through our list at number 5, we have retirement accounts. These accounts are more than just a comfortable nest egg for your golden years. By maxing out your contributions, you can significantly cut down your taxable income. The logic here is simple. The more you put into your retirement account, the less income you have to be taxed on. It's a win-win, really. You're saving for your future while reducing your present tax burden. Retirement accounts are not just for the future, they're a present tax-saving strategy too. At number 4, we have tax havens. These are countries or jurisdictions with very low effective tax rates for foreign investors. They're like fiscal paradise islands, where money can sunbathe without the worry of high taxation. Picture a billionaire, let's call him Mr. Moneybags. Now Mr. Moneybags doesn't fancy giving a large chunk of his fortune to the taxman, so he shifts his assets to a tax haven, like the Cayman Islands or Bermuda. There, his wealth can grow virtually tax-free. These tax havens attract huge amounts of foreign capital due to their low tax rates. It's a win-win situation. The tax haven gets investment, and the wealthy individual or corporation saves on taxes. However, this strategy is often criticized for its ethical implications. It's legal, but it can contribute to income inequality and deprive governments of needed revenue. Tax havens might sound exotic, but they're a practical strategy for many. Coming in at number 3, we have capital gains tax. Now this might sound a bit technical, but it's actually quite straightforward. Capital gains tax is levied on the profit from the sale of an asset, be it real estate, stocks, or even a piece of art. But here's the catch. The tax isn't due until the asset is sold. That's right. As long as the asset appreciates in value, the wealthy can sit back and watch their net worth grow, tax-free. The wealthy often hold on to these assets for a long time, sometimes even passing them on to the next generation. This strategy is known as buy and hold. In this way, they defer their tax liabilities, potentially indefinitely. But what happens if they need cash? Well, they borrow against these assets, again avoiding capital gains tax. So you see, capital gains tax isn't just about stocks and bonds, it's a major part of the rich's tax strategy. Almost at the top, at number 2, we have business expenses. This is a strategy that's as old as the idea of business itself. Now let's get one thing straight. This isn't about fudging numbers or cooking the books. Rather, it's about understanding how to legitimately classify personal expenses as business expenses. For instance, a wealthy entrepreneur might purchase a private jet. To the average person, this screams luxury, but to the savvy business person, it's a business expense. They can use it for corporate travel, meetings, or even client entertainment. The cost of the jet, its maintenance and operation can all be written off as business expenses, reducing the entrepreneur's taxable income significantly. Similarly, meals, travel, office space, and even some types of clothing can all fall under the umbrella of business expenses if used correctly. It's about knowing where the line is and staying on the right side of it. Running a business isn't just about making money, it's also about saving it. And finally, at number 1, we have tax laws. The realm of taxation isn't as rigid as you might think. Sure, there are rules, but these rules are subject to change, and often those with the most at stake have a say in how they're written. Imagine a chess game where you could alter the rules to favor your pieces. That's how the wealthy play the game of tax laws. This isn't about breaking the law, it's about shaping it. The rich can and do lobby for tax laws that benefit their financial situations. They hire armies of tax lawyers, accountants, and consultants who understand the intricate web of the tax system and can spot potential adjustments. These experts can influence policy, propose amendments, and even draft new laws. Remember, this isn't about evading taxes, it's about legally reducing their impact. Tax laws aren't set in stone. They're often shaped by those who stand to benefit the most. So there you have it, the top 10 ways the rich avoid paying taxes. From offshore accounts to tax havens, from real estate loopholes to retirement accounts, the strategies are as diverse as they are ingenious. But it's not about copying these methods, it's about understanding them. The more you know, the better equipped you are to navigate the often murky waters of taxation. Remember, knowledge is power.